Okay, we are live. Welcome, everybody. I have no idea where all of you are. We are streaming to multiple places. We're streaming to Facebook, we're streaming to LinkedIn, we're streaming to YouTube, and to our LLC Essentials community. So wherever you are, welcome. I would like to get started now because I want to be very cognizant of your time. We have just an incredibly packed agenda, and I want to make sure that we get through everything in a timely manner. My name is Wendy Byford. I am the co-founder and president of Your Entity Solution. I'll be your host for this webinar, and I'm here with my partner, Gary Bauer. Gary is going to be manning the comments. So if during the presentation you have questions or you'd like something repeated, then please put it in the comments. Gary's going to be monitoring those, and he will interrupt me as he needs to. Now, one of the things that is really important, if we do not get to a question, if something happens that we don't see it, then no problem. We will tell you at the end of the presentation how you can get hold of us. You can always send us your questions then. Okay, so with that, let's get started. And we're going to be talking about the 10 financial mistakes that cost business owners thousands. And at the end, I have 3 bonus mistakes as well that are a little bit more challenging. I don't normally go through these, but I think that you're a great audience and you'll really appreciate these. So we're going to be talking about the mistakes. We're going to be talking about the impact of each mistake and how to repair the damage. Now, one thing please to bear in mind, this is not an exhaustive information session. If we were going to do that, then we would be here until well past my bedtime. So we're not going to do that. The important thing is to make sure that each of you understands what the mistake is, what the potential impact could be, and if you've made the mistake, potentially how to repair the damage. So before we get started, I need to make our attorneys happy, so I need to tell you I'm not an attorney or a CPA. The course is designed to educate and provide general information regarding the subject matter. Law practices are different from state to state. Laws and practices are different from state to state, and they change frequently, particularly the IRS code, as you're aware. Your situation is also different from anything that I'm going to describe, so it's really important that you get advice from your particular professionals. Consult with your legal and your financial team before you make any changes. Now, what I'm going to be telling you about is going to help you to formulate the right questions to make you aware that perhaps you should be going to your team with issues. So just make sure that you don't rely on any of the information here to make your final decision. Talk with your team. Okay, that having been said, let's move on to our first mistake: choosing the wrong structure for your business. Now, first of all, let's talk about structure. By structure, I mean the entity type that you've chosen, plus the tax election that you're choosing for that entity. Together, the entity type and the tax election make up the structure for the business. Your entity type can be a corporation, a limited liability company, a limited partnership, or trust. The tax election is how you ask the IRS to tax that particular entity. In some instances, you don't have a choice. If you have a limited partnership, a limited liability partnership, or a limited liability limited partnership, that's a mouthful, you're going to be taxed as a partnership. You don't get a choice. But if you're a corporation, then you do get a choice on being taxed as a C Corp or as an S Corp. And if you're a limited liability company, you have the ability to be taxed as a sole proprietor for a single member LLC, a partnership for a multi-member LLC, or you can ask the IRS to tax you as a C or an S. So lots of choices. So those are your entities. Now, how can choosing the wrong structure be an issue? Well, here's the problem. Let's say that you set up a corporation and you decide to be taxed as a C Corp. And because somebody said that a C Corp was really cool, and so that's what you want to do. Well, if you're taking a high W-2 paycheck, you may be foregoing all of the tax advantages that you could have if you were taxed as a subchapter S. So you're paying more than you really need to because you have the wrong tax election for that entity and your particular situation. Yes, C Corps may be really cool, and there are some instances where having a C really is important. If you're setting up a large business, you've got partners, the C may actually make sense, particularly if some of your partners are non-resident foreign nationals or foreign companies. The C may actually be great. Or if you have medical issues where the company has to have its own medical program, that may be a good reason to have a C. But otherwise, the S may be better for you, and you can save on your taxes. There may be times also when you've been to a seminar and the person on stage said, oh, great, you're going to have this company, you need to be an S Corp. But at this point, you don't have any kind of indication as to whether or not you're going to want to do this type of business forever. You have lots of write-offs in your first year. You're starting the business later in the year, and you may not make enough money to make that subchapter S tax election worthwhile. So it may be 2 or 3 years before the S actually makes sense for you. But if you take it up front, then you have to file that 1120S tax return, which is more expensive. You're going to need to have a payroll company, which is an additional expense. You're going to have your bookkeeper track your distributions, which is also an additional expense. So you're going to pay more over a period of a minimum of 5 years. When you take that S election, you're stuck for 5 years, and all of those costs add up. And if you're not getting the benefit from the S, then you really have the wrong structure. Now, is there a way for you to actually make a change so that you can avoid some of these things? Well, if you've got an S, the only thing you can do is take the company down. If you are an LLC that should be taxed as an S, you take the S election. If you are a C and you should be an S, then you take the S election. So in some cases, yes, you can repair the damage. In other cases, you may just have to shoot the entity in the head and start over. Okay, so having the wrong structure can cost you thousands of dollars. However, acting as a sole proprietor could cost you everything. Now, what does that mean? Well, when you're a sole proprietor, you are the business. Years ago, when I was in a workshop, we had a little booth for your entity solution. And somebody walked up to me and said, I need to talk to you about setting up an LLC. And as I usually do, I say, okay, why? What's going on? And she said, well, the previous year, she had had a beauty salon as a sole proprietor. And she and her husband had sold their house. They lived in California. And this was during the time when everybody was screaming about black mold. Well, she and her husband got sued for mold in that house. Now, they figured they'd been targeted, but they went to court and she lost the lawsuit. But because she was a sole proprietor, she did not have her business in any kind of entity. She lost her business as well as everything else that she had. So she was starting over again, and she wanted to make sure this time that her business was protected, and she wanted it in that LLC. So acting as a sole proprietor can cost you everything. Now, there's also issues with having a lack of entity that may not cost you everything in court, but could lose contracts. There are companies that will not contract with individual people, with independent contractors, that they really want people to be companies. That's for their protection, so that if they get audited by the IRS doesn't say, oh, that person isn't an independent contractor, they're an employee, and you're now responsible for all of the employment taxes, back taxes, etc. So it's for their protection. They will hire you as a company, and your company decides who provides the work. In your case, you, or you could hire somebody else to do it, or they won't give you the contract at all. So being an entity sometimes is good because you could get business that otherwise you wouldn't be able to get. There's also a credibility issue. If you're a sole proprietor, then somebody might think that you're not going to be around long enough to look after their clients, and they don't want to refer people to you. But if you have an entity, then you've put in the time, the effort, the money to set up a company, and that kind of shows that you're committed to whatever it is that you're doing, and you will be around to look after their clients, so they're more willing to refer to you. So choosing the wrong structure can cost you thousands, but being a sole proprietor, you could lose everything, and not having an entity could cost you some business. All right, let's move on. Commingling funds is our second mistake. Now, everybody makes mistakes once in a while. So first of all, let's talk about what commingling really is. Commingling is when you pay business expenses from your personal account or personal credit card, or you pay personal expenses from your business account or business credit card. That's commingling funds. If you don't catch that and pay everything back or deal with it some other way, then it's commingling. Everybody makes mistakes once in a while. You pull out the wrong credit card and you put something on that card and you've commingled funds. Happens once in a while. But if it becomes a steady event where, it seems like once a month or twice a month, there's always something that's commingled, then this is one of the fastest ways to have your corporate veil pierced. If you go to court or you're audited by the IRS, they're looking to see that you are a professional business run professionally in order to say, A, that you're a business, and B, that the walls of your business should remain strong. If you are commingling your funds continuously, that shows that you're not running your business professionally. You're not doing things in a professional manner. And that gives the court a reason to pierce your corporate veil. Your corporate veil is that wall that stands between you and the business, that wall that's the LLC or the corporation, that your business is inside and you and all of your assets are outside. If the court pierces that corporate veil and you're in a lawsuit, then that means that all of your assets, both business and personal, are put at risk. If you lose the lawsuit and the judgment exceeds what your insurance will pay, then you could lose everything, including your business, because what the court has effectively done is it's made you a sole proprietor, just because you didn't keep your financials straight. And so, depending upon how many expenses you've taken, depending upon if you're an S, for example, you've had the benefit of distributions without any self-employment or payroll tax, those sorts of things, you could end up owing a lot of back taxes and a lot of penalties if that happens. You don't want to end up in a situation where your lackadaisical handling of your finances has actually put you in a situation where your corporate veil has been pierced and everything now is at risk and you owe a lot of back taxes. There are ways to handle this. And the most important thing is to realize, first of all, that you're doing this. So it means, first of all, being cognizant of what credit cards you're using, and also having a bookkeeper, we're going to talk about that in a minute, who has access to everything, all of your credit card statements and your bank account statements for both personal and business, so they can catch these things and help you avoid the situation. Now, some people will say, well, I have to pay business expenses from my personal account because I didn't capitalize the company with enough money. And so voila, I have to be able to pay the business expenses somehow, and my personal account is the only thing that has money in it. Understand that. But here's what you actually should be doing. You can lend money to the company if your initial capital is run out and you don't have enough money to move forward. You write a personal check to the company bank account, and then the company continues to pay the bills out of the company account. That's not commingling of funds. That's simply making a loan to the business. You're going to report the amount that you lent to the company to your bookkeeper to make sure that it goes on the books properly. You create a promissory note if the amount is $1,000 or more, and then you create and pass a resolution accepting the loan. Now, if you're lending $100 here, $50 here, $500 here, no problem. At the end of the year, add up everything that you have lent to the company, create one promissory note, do one resolution, pass that, and you're good to go. But again, all of this has to be on the books so that you can actually add it up and you know how much money has been lent to the company. So don't pay your business expenses from your personal account or your personal credit card, write that check, move the money over, and then continue to pay out of the company bank account the way that you should. Now, a lot of people are really afraid that, oh my goodness, I'm going to end up using the wrong credit card. I'm going to end up paying for personal groceries on a business credit card or whatever. Not a problem. You can create a standing resolution that says that if there is a situation where you have paid personal expenses from a business account or vice versa, and the expenses were not reimbursed within 30 days, that this automatically becomes a loan to the company or a loan to you, depending upon which way it went. And that will kind of protect you to say, hey, I thought about this. I knew that maybe once in a while there would be a mistake. So this is how I'm handling it. But still, you want to make sure that you are a good steward of the money in your business, and you make sure that your bookkeeper has access to everything that she needs so that she can catch these things. And then she can let you know at the end of the year, this is how much money you've lent to the company. This is how much money the company has lent to you. You can get the right promissory notes written up. You can get the right resolutions written up, and away you go. Okay. Number 3, having a home office and not being IRS compliant. Now, for some people, having a home office, they think is a red flag to the IRS. It used to be. But the IRS has kind of given up on that, and it's not so much of a red flag now. What is a red flag is if you are not compliant. So if they audit you and they see that your home office is really a desk in the corner of the living room, then that's an issue, because the IRS says that in order for you to write off your home office, that it must be a space that is used only for business, and all of the furniture and the equipment in there also must be used only for business. So how do you solve the problem? If your house is too small for you to use a room in the house as your office with a door, then screen off that area in the living room and make sure that it's completely screened off, not just a, one screen or 2 screens, but, hole in the middle sort of thing. You want it screened off like a real room with just a little opening for you to go into the office, and everything in there, the desk, the computers, everything are used solely for business. You can't allow your children, for example, to go in and use the computer for their homework. You can't allow them to use it for gaming, for example. If you have a separate room in your house as an office, great, but it can't be used as a guest room 2 weeks of the year when your mother-in-law or your father-in-law comes to visit, right? It's solely for business use and must be kept that way. And in order to prove that the office is set up like an office, you should actually take pictures. This is really important. Documentation is your best defense always. So make sure that you take pictures showing if it's screened off the outside to show that it's completely screened off. Show the inside of the office. Anytime you make changes, take another picture so that the IRS knows that you are being compliant. Now, why is this important? You can write off a substantial amount of your household expenses as business expenses if you do this correctly. So let's say, for example, that 10% of your house is used for business. If you've got an 1,800 square foot house, 180 square feet are used for business, then that's 10%. You can take your mortgage, water, gas, electricity, maintenance, security monitoring, cleaning, anything sort of for the inside of the house, and you can write off 10% of that as a business expense. So this could mean real dollars for you. You can't write off outside. So you can't write off landscaping or pool maintenance or anything like that. But on the inside, absolutely. And if you have a separate room as your office, excuse me, then if you paint that room, you can write off all the supplies for painting of that room. Anything that is specifically for that office can be written off. Excuse me. So my office in my house is 400 square feet. And when we painted it, all of that got written off. We have a separate lavatory in the office that is only used for business. It's only used when I'm in here working, or if I have people coming to the house for business. And excuse me, if something happens that I have to bring in a plumber, that plumber gets paid by the business. So make sure that that you're in compliance, and it can be worth a lot of money for you. Number 4, failing to understand the rules for business expenses. Now, I'm not going to go through these in detail because frankly, they just change too often, but it does mean that, excuse me, you're going to have a conversation with your CPA frequently. Now, one of the things you need to know is take meals, because meals are a common write-off. You need to know who you were with, where you ate. You need to know what was the meal. Was it a meal, snack, catering, groceries, whatever? Was this entertainment? And was this really an employer convenience meal, like a lunch and learn, or a way of bribing your employees to stay late because you've got a lot of work to do? If you're having lunch, for example, with a client, that's 50% deductible. Even if you are then treating your client to an entertainment, like golf or a concert or something, which is not a write-off, if the meal beforehand or afterwards you are discussing business at least part of the time, then you can still write off 50% of the meal. However, as I said earlier, for employee convenience meals, bringing in snacks for your employees, lunch and learns for employees, convenience meals for employees, or if you leave the office, go have a meal and then come back to work, none of that is a write-off anymore. All of that is gone. However, what you can write off 100% is a company event that's open to the entire company. So if you have a holiday party, if you have a picnic or something like that, then you can actually write that off and write that off by 100%. Travel is another thing that people often get wrong. In order to write off anything, the purpose of the trip, or in order to write off the airfare, the transportation, etc., the purpose of the trip has to be business. That means that you have to be working the majority of the time, and a work day is a minimum of 4 hours long. So that means that the majority of weekdays of the trip, you have to actually be working, and that way you can write off your airfare, you can write off your transportation, car rental, whatever. And on the days that you're working, you can write off your lodging, you can write off your 50% of your meals, or you can write off your meals 50%. That's probably a better way to put it. You can also write off incidentals. If you're gone 5 days or more, you can write off laundry, you can write off tips. You can write off grooming if a part of your business really requires you to look a specific way. If you're a realtor or you're doing a keynote speech or something like that, and you need to, get a haircut or something, then you can do that. So some of those things you're able to write off as well. The important thing here is documentation. It's really important that you document the purpose of the trip. Document every day that you work, how long you work, when you start, when you stopped, who you saw, what you did. The more documentation you have in this regard, the better off you're going to be. And also talk to your CPA about these things, because as I said, rules change. And in this area of business expenses, they change frequently. So before you decide to go on a trip like this, talk to your CPA. And if you are traveling internationally, the rules are different. Make sure that you talk to your CPA before you finish planning your trip. Okay, number 5, failing to create and pass resolutions. Now, remember what I said, that the court and the IRS are looking to see that you are running a professional business run by a professional manager, and that you're not running a hobby. Why is this such an important thing? Well, because with a hobby, you're going to get taxed on all of the income you bring in, but you cannot write off any expenses. Now, think about that. If you have, so much income, and then you've got 50% of that is expenses, if you could not write that off because you were deemed to be a hobby, that would be a huge blow, right? So you want to make sure that you are running your business as if it were a corporation. In fact, I had an attorney tell me a few years ago, the closer to a corporation that you look, the better off you are. So that means that you're going to document everything that's of legal, tax, and financial significance. So when you're new, opening a bank account is a big deal. Getting a credit card or a merchant services account is a big deal. purchasing an asset, selling an asset worth more than a certain amount is a big deal. When you're first starting out, that might be $500. As you grow, that might then change from a $500 to $1,000. But it needs to be documented. Loans to a manager, a member, or an officer. You want to get those documented. A loan to the company, get that documented, as we talked about earlier. Paying back a loan, get that documented. And then to expense assets valued at less than $2,500 each, you want to have a blanket resolution for that says that it's now company policy. That's really important because if you get audited, the IRS is going to look for that. You also, as I said earlier, are going to have the standing resolution where expenses not reimbursed within 30 days are a loan to the company or to you, depending upon which way it went. So these are all things that you want to create and pass and have those documented and in your company record book, because it's evidence that you've thought about these things and you are running your business professionally. It's really important because if you go to court or you get audited, one of the things that they're going to pull is that company record book, and they expect to see documentation in there. Okay, number 6, doing your own bookkeeping and being your own CPA, right? Doing your own bookkeeping can cost you a ton of money, right? Think about this. Let's say that you value your time at, I don't know, $100 an hour, let's say. Great. You're valued at $100 an hour. And let's say that you spend 2 hours a month. That's not very long. 2 hours a month doing your own bookkeeping. Well, those 2 hours are $200 worth of your time. If you could hire somebody for $50 an hour, wouldn't that be a better use of your money, of your time? Like, you could be doing marketing. You could be spending time on setting up systems for sales and delivery. You could be doing all of those things that you need to build the infrastructure in your company to scale. You don't need to be doing your own bookkeeping or trying to be your own CPA. It's really costing you money to do that. Leave it to the bookkeepers who can do it faster and better than you ever will, because this is their job. And they will catch things that you won't catch. They're going to look at all of your credit cards. They're going to look at all of your bank statements. They're going to look at anything, any receipts or whatnot that you have for cash. And they're going to catch when you've commingled funds. They're going to see things that perhaps you hadn't thought you could write off, but you could. Let them do their job, because it will save you money in the long run. By the way, if you have QuickBooks Desktop because you want to do your own bookkeeping, that is being phased out, and it's really good time for you to migrate over to online. And what a better time to get hold of a bookkeeper who probably already has Online Pro now and can get you set up and on your way. Mistake number 7, failing to read your financial reports. Now, I know that if you've got a CPA and you've got a bookkeeper, they are probably haranguing you to read your reports. Why? Because this is what tells you whether you're on track or off track, right? Just because you have money in the bank doesn't mean you're profitable. You're only going to find that out by reading your income statement, right? You can say that you've got a whole bunch of money in the bank, but you don't see the expenses that are coming down the track. So you can't tell just by looking at that whether or not you're in the black or you're in the red. You need to read your income statement every month. You also need to read your balance sheet. Your balance sheet basically says what you own versus what you owe. And this tells you whether or not you have a healthy business. If you're running your business based on credit cards, as an example, and you're in severe debt, your balance sheet is going to show this, and you know that you don't have a healthy business. If you're planning on selling your business in 2 or 3 years, then looking at that balance sheet is going to give you an idea of, hey, there are things in here that I need to get cleaned up, and there are things that I need to ramp up so that I am in a healthy position to put my business on the market. Cash flow. Cash flow shows when you've got a cash crunch coming, because it's going to show you your ins and your outs. There's a reason why they say that cash is king. A lot of times new businesses fail because they just run out of money, right? Your cash flow statement is going to help you to figure out when your cash heavy times are, when your cash light times are, so that you can plan better. So you really want to make sure that you read those financial reports. And if you don't understand them, get together with your CPA on a regular basis and go through the reports with him so that they can explain everything to you. And then you'll know exactly what you're looking for as you go forward. Mistake number 8, misunderstanding the rules for merchant services accounts. Now, this is really important because failure to do this can result in all kinds of things, like having your businesses kicked out, right? Merchant services account provider can say, you know, we're done with you. And then you don't have a way of taking money, or you don't have a way of taking credit cards. They can put holds on your account. They can stop processing. So, for example, if you have a certain amount of money that you're processing every month, and then all of a sudden you start to ramp really fast and you're going past those limits, your merchant services provider can stop processing. There's nothing that says that they have to keep processing. They can stop processing and say, we'll pick this up next month, because you haven't kept up with notifying them of how fast your business is running. So you need to keep your merchant services account provider updated on your sales. That way, as you're ramping, if you're ramping really fast, it's not going to be an issue, because they know what's happening. You've explained that you've launched a new product. The product is really successful. And now the orders are coming in really fast, so that they can say, okay, this isn't a scam. This isn't an issue. They understand what's going on. You need to maintain tight security if you are taking any credit card numbers that you then put in later on into a system that then does the invoicing, or does the invoice processing. You have to make sure that any paper files are locked away. You have to make sure that there's adequate security on computer files. If you don't understand what the rules are, and there are significant rules for any of this, then please get together with someone who specializes in cybersecurity. There are a number of IT companies right now that specialize in cybersecurity. There are people who do this as well, who will do an audit for you and let you know where you are at risk. It's your responsibility to provide adequate security in this area, so make sure that you do it. You also have to make sure that you understand what the delivery rules are for your particular merchant services account, and that you stay within those rules. Typically, you're going to have to deliver within 45 days of billing, and that's to eliminate risk on the side of the merchant services provider. Generally speaking, somebody can claim against a purchase for between 60 and 120 days. Well, if they need to make that claim within 120 days and you're not delivering for 180 days, then things are going to get a little crazy. And probably the merchant services provider is going to shut down your account and say, we can't deal with you. It takes you too long to deliver, and people are telling us that you haven't delivered. They want their money back. So make sure that you understand what the rules are for your account. Typically, it's going to be within about 45 days of billing. Make sure that you use only one account per company. It may be really, really tempting to say, hey, you know, I've got this product that technically is sold by this other business that I have, but I'm going to run it through this particular account. You can't do that, because it's called money laundering. You can go to jail for that. I'm serious. So make sure that you are running only things for that business through that business's account, because if there's any hint that you might be doing something that's unethical, you're going to get shut down really fast. Treat your merchant services account providers with respect. Let them know what's going on. If you have questions, get hold of them and ask before you do something that could put your account at risk. There are lots of people who have ignored these rules and run a couple of $100,000 in credit cards through the account and found that their accounts have been put on hold, that their accounts have been shut down, that there are a certain amount of money that is being put aside in case of chargebacks. All these things happen if your merchant services provider doesn't understand what you're doing. So treat these guys with respect and talk to them. Okay, number 9, failing to represent yourself appropriately or get the proper insurance. Now, I can't tell you how many times I've had people with LLCs say to me that Yeah, they've signed a contract. Everything's good. They've got an LLC. The LLC is going to protect their business, but they signed the contract in their own name. And a perfect example: somebody buys a rental property. They put a tenant in and they sign the lease in their own name. Then they move the property into the LLC and they say they're protected, but the contract is still signed by them personally. You need to make sure that that contract gets re-signed in the name of the LLC with you as the manager, right? You have to do that in order for the LLC to provide you with the protections that it should. So don't assume that just because something is in an LLC that you're protected if you have been signing with your own name. And also make sure that you know, according to your operating agreement, what level of authority you need to have before you sign. If you're a managed LLC, then some things you can sign as the manager of the company. Some things you're going to have to sign as the member of the company. Know which you need to be, and that comes from your operating agreement. So rule number one, read your operating agreement. Make sure that you understand where the boundaries are so that you do things correctly and you don't find that all of a sudden everything is at risk because you did it incorrectly. The other thing is make sure that you have insurance. Your insurance is always your first line of defense. Your walls of your LLC are your last lines of defense. So make sure that you have the proper insurance. And this is for things like general business liability. If you've got a home-based business and somebody comes to your office and trips and falls and sues you, your home insurance will probably not cover it because this was a business visit. You need to have general business liability insurance. If you are doing something where you personally can cause harm, you're a hairdresser, you're a coach, you're a consultant, you're a podcaster, you're a whatever. If somebody sues you, they're going to sue you and the LLC. You have personal liability, so you have to have professional liability insurance for whatever it is that you're doing. Make sure that you have that insurance and that you're not completely out of pocket if you're sued. Also, sometimes people get sued just because they're the manager or the director or officer of a corporation. Well, if that's the case, you probably have a line in your bylaws for the corporation or your operating agreement for the LLC that says that you're indemnified. Great. You have to have the money in order to hire the attorneys to look after the case in the case that you're indemnifying the people in the company. So that line is meaningless if you don't have the money in the bank account to pay. This is where insurance comes in. So you can get directors and officers insurance to cover those situations, and you need to be you need to make sure that you look into that and get that set up. Okay, we're coming down to the last of our original 10, which is failing to understand and plan for your tax obligations. It is amazing how many people, especially in their first couple of years of operation, forget that they have to pay taxes, and it's really, really important. So we're talking not only about income tax. Sometimes people remember income tax, and that's fine. But there's also for payroll, employee withholding. And if you've got employees in some states, even if you have only one employee, you have to have workers' comp insurance. Sales and use tax is really important to know about because you may have to pay that as well. There may be specialty taxes in your state, wherever it is you're doing business, for alcohol and gasoline. And if you're in those industries, you're going to need to know that. Real property tax is something that you may have to pay. Business personal property tax. This is something that gets a lot of people. They don't understand what business personal property tax is. That's basically a tax on what your company uses in order to do business. It's basically a whole list of your furniture and your equipment and other things that you're using for business. They look at that, the value, how long of a lifespan those things are going to have, and they charge you a tax. We get one of those lists every year, and we have to pay our business personal property tax for your entity solution. So go look at that and just make sure that you understand what that is and make sure that it gets paid. Also, business licenses, which is kind of a form of tax. If you have business licenses, those need to be renewed. You kind of treat those like a tax every year. You have to do it. Now, remember that you're taxed on profit. You're not taxed on what you took out of the company. So it doesn't matter whether or not you took the money out of your bank account, you're still going to get taxed on the profit, even if it's still sitting in the bank. It has nothing to do with what you took out of the company or left in the bank account. It has everything to do with what your profit is at the end of the year. And that goes back to looking at your income statements and understanding what your tax obligations are going to be as you go forward. Okay, we're making good time. We still have 3 heavy hitters to go, and these are really important. So the first one, failing to capitalize your business adequately. Now, I have heard people say, don't worry about it, set up your company, put $100 in the bank, you're good to go. That's actually not true. If you go to court, particularly, the court is going to look at how is your business capitalized? Was there enough money in there to get your business started? Were you treating your business like a real business? Or were you treating it like a proof of concept that might work, might not work? Were you actually setting it up to be successful? And if not, if you only capitalize with $100 and the court sees that you've been putting money into the business month after month after month after month, then it's going to say you never really intended this to be a real business to begin with. And it can pierce your corporate veil, which, as I said earlier, puts everything that you own at risk, right? Not a good idea. Then, of course, the IRS comes along and says, well, if the court says that you're not a real business, then that means that you're operating at best as a sole proprietor, at worst as a hobby. And there's a whole other issue then with back taxes and penalties, which you don't want to have to deal with. So what's a good calculation to capitalize your business adequately? You take the monthly expenses that you're going to have to run the business times the number of months that it will take until you think that the business is going to be able to operate to pay those expenses on its own. So that'll give you the base amount, and then multiply that by 2. If you're in a risky business, multiply it by 3, and that's your amount of capitalization. Why? The runway is longer than you think. Let's say, for example, that you think it's going to take you 8 months to get up and running and for the business to be able to pay on its own, pay all the expenses on its own. Well, 8 months may be a good estimation, but plan for 16, because it's going to take longer than you think in order to get that business up and running. And using debt to float operations can actually sink your business. You can end up with so much debt that all the money coming in is going out again just to pay that debt. And you're not getting anywhere. And you don't have any money to scale. You don't have any money to hire the help that you need. You're basically going under. So make sure that you capitalize your business adequately from the get-go. Now, if you're in a situation where you started and you're undercapitalized and you've been lending money to the company, then talk to your CPA about restructuring part of that loan at least as additional capital. That'll show that, to the court that, yes, you miscalculated, but you made an additional capital call and put that money into the company. So it's not money that the company has to pay you back. It's part of the capital for the company to keep going. Okay, so that's actually a big thing. If somebody says, don't worry about it, just put $100 into the bank, don't do it, because the court will blow through your corporate walls. And the IRS, if they audit you, could actually say, no, you haven't really capitalized this company. This is really a hobby. And you don't want that to happen because, as we said, there are penalties. Okay. Number 12, failing to sign contracts. Now, I know that all of us want to think that everybody in the world is great. They're going to do exactly what they say they're going to do, and everything's going to be fine. We don't need to have those contracts either for employees or for independent contractors or for services, right? Wrong. If it isn't in writing, you have no proof of an agreement. Okay? Even worse, you might think you have an agreement, but what's in your mind and what's in the other party's mind may not be a match. And until you put it on paper, you may never understand that you're not seeing the same thing. The words don't mean the same thing. When you have to write out a contract, All of these things are going to come to the surface, and you can deal with them before anybody signs. And that's really important. Now, agreements should have the parties, the legal names of the parties, no nicknames, no DBAs, the actual legal name of your LLC or corporation, the actual name of the other party. There has to be an offer and an acceptance, exactly what is going to be on offer and what the other person is accepting. And that's the meetings of the mind. If you don't have a meeting of the minds, you do not have a contract. This is when putting things in writing is really important, because if that person reads the offer and it isn't what they're thinking, they can question it, and you can get that sorted out right up front. And of course, both of you have to be old enough to sign a contract. Both of you have to be mentally capable of signing a contract. So that's capacity. You have to know which state laws are going to prevail, especially if you're hiring an independent contractor from another state. If something happens, you need to know whose laws are going to prevail. If you're doing the hiring, you want your laws to prevail. If there's going to be a lawsuit, you want it to happen in your court system. So that needs to be spelled out. You need to know what's going to happen in the event that there's a default on either side, right? Either you default or they default. How is it going to be handled? Are you going to go to arbitration before somebody is allowed to go to a lawsuit? What's the process going to be? That's really important to spell out. Nobody wants to think that there's going to be a default, but it's kind of like planning the divorce before you get married. You know what's going to happen if the worst possible thing occurs. So make sure that you have that in your contract. What's the consideration and the payment terms, right? That's really important, because if you're going to do 3 payments, you want to know at what point that payment is due. And you need to know, both of you, that this work has been completed, and that, so now the payment is due. If they think it's been completed and you think it hasn't been completed, then you've got an issue, because now you've got a he said, she said, people's opinions come into effect, and now you're yelling at each other on either side. You need to have everything spelled out in a statement of work where there is no argument as to whether or not this is done, that's done, and payment is due. You need to know what timeframes you're talking about, what the effective date of the contract is, and official communications. So if you're going to send an official communication stating that this part of the work has been done, how is that done? Is it going to be email? Is it going to be a letter? How is it going to be sent? Is it going to be thrown in the mail? Do you have to do something by courier? How is it going to happen? And cancellation terms or renewal, right? You have to spell those out. So if you give each other 30 days to cancel, how does notice of cancellation happen, right? And does there have to be something that happened in order for you to cancel, or it's just anybody can cancel if they feel like it? You want to have all of that spelled out. And as I said earlier, there needs to be a very clear statement of work, and the work has to be legal, right? You can't have a contract that stands up for doing something that's illegal. And believe me, I know that somebody would say, well, why would you even think about that? I have had people ask me if I can set up LLCs or do contracts for things that are illegal. And the answer is no. Okay. Employment contracts, these are incredibly important, and so many people fail to do this. The issue is that your employment contract can cover things that are extremely important. Remember, we said that it's your responsibility to protect customer information. Well, if you don't have that in the employee contract, then the employee can do things and you can't go after them because you never told them they couldn't, right? So you want to make sure that everything is spelled out as being proprietary. Your processes and procedures are proprietary. Your customer list is protected. Anything that you bring into the company is yours. Any work that's done for the company or for a client on behalf of the company belongs to you or belongs to the customer, does not belong to the employee. All of these things need to be spelled out in an employment contract, and it's incredibly important that you do that. I actually know the situation where somebody hired an employee, no employee contract. The employee stole the entire customer list, went out and started his own company. And there wasn't a thing that the employer could do because there was no contract telling him that he couldn't do it. There was nothing to say that that customer list, that client list was proprietary. There was nothing saying that any of the information about the clients, their phone numbers, their addresses, whatever, were proprietary information or protected information. None of that was there. And so There was no way to go after that employee of doing that. Was it unethical? Absolutely. But you can't go to court based on unethical, right? It's got to be in the contract. And then make sure that you always, always, always sign the contract with the company name and then your name and title. So it's your entity solution, Wendy Byford, president, or Wendy Byford, manager, whatever title I happen to be using. But that's the way that it has to be signed, because otherwise it looks like I'm signing this on my own. And as we said earlier, that could cause a whole area of hurt. So don't get into a situation where you've got a he said, she said, where something drastic happens that's costing you money, where you pay for something and it's not delivered, whatever it is. Always make sure that you've got a contract. Okay, let's keep going. Last one that we're coming up on. Number 13. This is huge. Failing to operate for profit. Now, most people will think that they're trying to be profitable. And in their mind, they are. And when they look at their income statement, they find that they're continually in the red. And there's a number of reasons for that people don't think about. First is fear of pricing for value. You may be, particularly if you're a coach, a consultant, an educator, you often, especially if you're just starting out, you will undervalue what you deliver. You're not taking all of your previous experience, all of the years that you've been doing this, perhaps for another company, everything that you've got at your disposal. You've got a fear of pricing for that real value. And so you say, well, for a little while, I'll underprice. I'll set it at a lower price and I'll make it up in volume. So rule number one, you're not going to make it up in volume. That doesn't happen. You dig a bigger and bigger hole when you do that. You need to make sure that you understand the value of what you're delivering and you price accordingly. And think about this. There are going to be times when you want to do something and nobody is going to purchase it because the price is too low. You're pricing yourself right out of the market because you're not setting the bar high enough. So think about that. Sometimes people will say, well, I'll just discount something and then later on we'll go back to the normal price. But discounting can become an addiction. There is a company that I have purchased a few things from, and every other day, I'm not even talking about once a month, there is a sale. And so it's a joke. I know that when they say, oh, this is a great sale and this is never going to happen again, I know they're lying. It's going to happen the next day. They constantly are discounting. And so I take a look at what they're selling the product for, and that's the value of the product, not the value that they say is the real price, but the discounted price, because they're constantly discounting. And so they don't have any real value at the level that they say they do. Serving unprofitable customers is also something that we do because we're afraid to let go of a high volume client, but it may be costing us more to service that client than the client is worth. I remember years ago, when I was in the first company that I joined after getting out of university, I was talking to the CFO of the company, and the sales rep had just come barreling out of his office, and he was really upset. And so I said to the CFO, who happened to be a friend, what's going on? And he said, well, I just told him that we were going to cut off his client. They had $1 million client, and he tried to explain to the sales rep, who was earning commissions on that $1 million, by the way, that this wasn't $1 million client. This was $1 million loss. That client cost so much to service that it was actually causing the company to lose money on every single order that came in. So they were going to cut that client off. And you need to look, that's where you need to look at your statements and find out where the money is really coming from and where the money's going to and who's bringing you profit and who's not. That's incredibly important. So few people do that. And yet, once you figure out that perhaps the top 80% of the people that you serve are costing you money and 20% are actually bringing you in money, maybe you stop whatever it is that 80% is buying and you concentrate on getting more of the 20%, and all of a sudden your profit will shoot up. Staffing for operations and efficiencies. A lot of times people will try to band-aid situations where they really need to look at the operation. So you spend money, you're already in the hole, you're spending money now, bringing in people to band-aid the situation, which just makes it worse because you're not solving any problem. You're just putting band-aids on stuff so you can get things out the door. When in fact, if you just stopped, took a look at the operations, you could probably in a very short period of time fix those inefficiencies and it would go straight to your bottom line. Another thing is cutting the wrong cost during the slow period, that you cut the things that really will help you to start scaling again once your slow period stops. And you end up with situations where you end up with rework because you now got quality issues or other things that go against your margin. So you've got to be really careful about what you cut in a slow period to make sure that it's not anything that you really need to keep the quality and the efficiency going, so that when you come back, you can take off again. And then scaling without a buffer. I've heard of people who've scaled by putting everything on credit cards, which is really high cost debt. You don't want to do that. If you're planning to scale and you've got everything in place, like your foundation is built, please don't scale before your foundation is built. But you've got a good foundation, you're ready to go. Don't scale without a buffer, because you may start to scale stall until you kind of find your footing and keep going. And you want to make sure that you've got a buffer to be able to handle doing things faster, so that your output may be faster than your incoming money. And you want to make sure that you've got a buffer until you can get that steady flow going. That means you might need an SBA loan, or you may need some other form of funding that is not a credit card, right? So please make sure that you look at that. As I said earlier, more clients aren't going to solve a profitability problem. They're just going to make it bigger. So failing to operate for profit happens so fast that people don't even realize it's happening. Make sure that you've got things in place where you will see this. And one of those things is making sure that you read your statements. And if you don't understand them, sit down with your CPA and go through them. Get out your magnifying glass, do a little bit of forensics work, figure out where problems are and get those fixed, so that when you are ready to scale, you can do that profitably and keep going and build your 7-figure company. Okay, so those are the things that I wanted to bring up. And with your permission, I'd like to, thank you. I would like to tell you about how you can find out more information, because we never want to leave you with just with just what we've given you. Talking about the financials is just one of the things that we talk about in our LLC Essentials course. When we set up an LLC for years now, we've put our clients into a course and they can go through an entire 13 hours of training. We have over 50 videos. We have numerous bonuses that they can download. We've got live tutorials every week. We've got a course community and a whole other course that provides templates for meeting minutes and resolutions. Remember I told you to document things? You can document them super fast using all the templates that we give you as part of the course. Well, for many years now, that course has been available only to our clients. And this year, for the first time, we've opened it up to people who are not our clients. So if you are somebody who set up your own LLC, or you had somebody else do it, or you have clients who set up their own LLCs, they can still now get the same quality of training as we give our clients by purchasing the course. And the way that they can do that is to go to essentials.yourenitysolution.com, and it outlines what the course is, everything that they'll get, and they can purchase the course there. Now, if you are a coach, a consultant, or somebody who has clients that could really use this, then the important thing is to sign up as an affiliate, and I can tell you how to do that, so that we can pay you for helping us to do our marketing. So either way, if you're somebody that needs the course, you can purchase it. If you are somebody who would like to sell the course, then you can certainly do that as an affiliate. Right now, we have a launch price that's going of $597 until April 1st. and that has a 30-day refund policy, or 3 times $250, and there's no refund policy for a payment plan. After April 1st, the price is going to go up to what what we think that the price should be, $898. There will be still a 30-day refund policy with full payment. And if you really want that refund policy, then this is a great option for you. If you would rather do a payment plan, then we have 3 payments at $300 each payment, and there's no refund policy for that. Access, of course, is contingent upon payment. So that's available to you. The course is worth about $2,400, $2,500 by the time we count up everything that's in there. But we figured that $898 was a good place for us to land for our clients, and looking forward to seeing some of you in the class and, of course, in the tutorials. Now, I'm going to break here. I'm going to put up again what you get with the course. But while I'm breaking here, I'm going to see if anybody has questions. You can put questions into the comments. I've seen that there's some comments coming in. Thank you to the LinkedIn user who said great information. Appreciate that. If you've got any questions, you're welcome to put them in now, and I'll be happy to answer them. Okay, I must be brilliant because I don't see any questions coming in. If you think of questions afterwards, then this is how you get hold of me. The best ways to get hold of me, in all honesty, are email or text. The office number, usually I'm on the phone, so I very rarely answer the office phone because I'm usually on the phone. But you can text me, you can email me, you can get me through LinkedIn. I love LinkedIn. I do a lot of posting there, so you're welcome to follow me there, and send questions in. Just say that you saw the presentation and you've got a question, and I'll be happy to answer it. If not, then I will send you to the right resource. How do you become an affiliate? Great question. So it's actually much like going to the actual course. So to the course, it's essentials.yourenitysolution.com. And to become an affiliate, it's affiliates.yourenitysolution.com. So affiliate with an S on the end, so it's plural, affiliates.yourenitysolution.com. It will bring up a way for you to sign up as an affiliate. You'll then get an email with your link in, and then just make sure that you give people your link. It will take those folks to the essentials page, the sales page, but it will be attached to you. And the whole process is handled on a platform that makes it automagical. After the 30-day refund period for full payment, then you get paid your referral fee, and we're more than happy to do that. Thank you. I'm glad that the presentation was useful to you. Appreciate this. We're planning on doing presentations every month, so stay tuned for the next one's coming up. We'd love to see you. And if you have anybody that you think should have seen this, then we will be putting up the replay in our website, which is yourenitysolution.com. They'll be able to see the replay there. They can't necessarily ask questions like you did, but they'll be able to see the replay. Okay, any last questions before I go? Anything that is not clear? And it looks like I can post a comment. So I'm going to post the affiliate link. Make sure that I spelled this correctly. Okay, there we go. Okay, there we go. There's the link for affiliates. So if there's anything else that you guys need, would love to hear from you. If there's any topics that you want us to talk about, would love to hear that as well. Otherwise, I'm going to end the live stream. Thank you very much for being here and spending some time with us. And I hope you have a great rest of your day. Take care.